Welcome to The Explainer. Today we are deconstructing one of the most famous and, let's be honest, debated models in all of finance, the Capital Asset Pricing Model, or CAP for short. When you boil it all down, all of investing really comes down to this one question. It's the big trade-off, right? The one that every single investor has to face, whether you're just starting out or you're managing billions. And here's our answer first for you. The CAPM gives us a formula to try and solve that puzzle. But as you're about to see, the real magic isn't in the number it spits out. The formula has its issues for sure. The real value is in the way it teaches you to think. Okay, let's jump in. So here's how we're going to break it down. We'll start with the problem CAPM was designed to solve. Then we'll take apart the formula piece by piece. After that, we'll look at where the theory clashes with reality, why it's still so useful, and finally, what came next. All right, first things first, let's get to the core of the issue. Back in the 1960s, finance needed a structured way to answer that big question about risk. So what is it? Well, in plain English, CAPM is a formula that tries to tell you what return an investment should give you based on how much risk it adds to the whole market. It's basically an attempt to put a number on that gut feeling we all have. Riskier stuff should pay more. And here's why that's so important. As an investor, you demand to get paid for two things. First, just for the time your money is tied up. But second, and this is the key part, for taking on the extra risk that you might not get it all back. CAPM is all about quantifying that second piece, the reward for being brave. Okay, now for the fun part. Let's pop the hood and look at the engine of this thing. We're going to see exactly how the model builds that bridge between risk and return. And there it is, in all its glory. Now, I know what you might be thinking. A formula? But hang with me here because it's way more intuitive than it looks. It's really just three simple ideas bolted together. Let's pull them apart one by one.
So, component number one, the risk-free rate. This is your foundation, your starting point. It's what you could get without breaking a sweat, absolutely no risk involved. Think of it as the base salary you get just for showing up. Everything else is a bonus on top of this.
Next up, the market risk premium. This is the extra juice you expect to get for taking on the general risk of being in the stock market at all. I mean, if you're going to ride the roller coaster of the whole economy, you'd better get paid more than the person sitting on the sidelines with a safe government bond, right? That extra pay is the market risk premium. And finally, we have beta. This is the secret sauce that makes the formula specific to one particular stock. I love this analogy. Think of beta like a car's suspension. A beta of 1 is just a normal family sedan. It moves right along with the road, pretty predictably. A beta over 1, that's a sports car with stiff suspension. You feel every bump and then some. And a beta under 1 is like a big, heavy luxury truck. It smooths out the ride.
Let's put some numbers to this to make it real. Let's say the risk-free rate is 3%, and the whole market is expected to return 8%. Well, that gives us a market risk premium of 5%. Now, if we're looking at a stock with a beta of 1.3, our bouncy sports car, we multiply that 1.3 by the 5% premium, which gets us 6.5%. You add that to your starting 3%, and voila, the model says you should demand a 9.5% return to make this investment worth your while.
Okay, so we've got this really neat and tidy formula. The problem? Well, it's built on a set of assumptions that, let's just say, they don't always match up with the real world. This is where things get messy. And this was a bombshell. This finding from two of the biggest names in finance basically called the whole model into question. If beta, the model's main engine for risk, doesn't actually explain why some stocks do better than others, then you've got a serious problem. This chart just lays it out so perfectly. The world on the left is a perfect laboratory. Everyone has the same information, everyone's perfectly rational, no taxes, no fees. The world on the right? That's the messy, emotional, complicated world you and I actually live and invest in. And this gap, this is where all the criticism of CAPM comes from. So, given all that, you're probably wondering, why are we still talking about this thing? If it's built on a shaky foundation, what good is it? Well, it turns out, even a flawed tool can be incredibly powerful if you know how to use it. It's not about finding the perfect answer. It's about asking the right questions. Right, so nobody in their right mind treats the CAPM number as gospel. Instead, smart consultants and analysts use it as a strategic tool. It's a sanity check. It's a way to compare apples to apples when looking at different stocks. It's a framework that forces you to be disciplined and ask, am I really getting paid enough for this risk? Let me give you a classic example. An advisor comes to you, all excited about a stock, and to prove their point, they show you a CAP calculation that says you should expect a fantastic 13% return. This is where the model becomes so powerful. Instead of just accepting that 13%, you can now use the framework to push back. You can say, wait a minute, this stock has historically returned 9%, and its competitors are around 10.5%. Why should I suddenly believe it's going to hit 13%? What's fundamentally changed? See, the question itself is way more valuable than the initial answer. Look, CAPM was revolutionary. It truly was. But it wasn't the end of the story. The debate it started actually pushed researchers to build even better, more sophisticated models. So let's take a quick look at what came next. You can see a clear story unfolding here. We started with the basic idea of portfolios. Then CAPM simplified it down to one single risk factor, beta. But then researchers started saying, hey, what about other things? And that led to models that added in factors like a company's size or whether it's a value stock. The search for a better explanation was on. And this table really sums up that evolution. We went from the simple one-factor world of CAPM to a much richer multi-factor world. We started trying to capture more of what's really going on under the surface, things like size, value, profitability, to get a more complete picture of what drives returns. So what's the bottom line? CAPM is not a crystal ball. It's not perfect, but writing it off is a huge mistake. It's the essential first step. It's the thing that taught us the language we use to talk about risk and return. Every single advanced model that exists today is, in one way or another, standing on CAPM's shoulders. And that leaves us with a really fascinating question to think about. The fact that we keep adding more factors, from 1 to 3 to 5, proves that our understanding is never complete. So you have to wonder, what are the big, undiscovered risks that are driving the market right now, just waiting for the next brilliant model to come along and identify them?